Hello, Assalamu alaikum. Hope everyone is well today. Apologies for delay. I think we've been having some issues around the internet, but apologies for that. Inshallah, today our session, inshallah, would be on uh, pensions. But I think before I sort of get into the I guess the content of the today's topic, just quick some disclaimers. Any examples that we use, any illustrations that we go through, they are just there for the purpose of education, and generally tax rules may change. So it's always best to kind of before you act upon anything is to make sure that you get the right advice, basically. So we've got sort of four broad sort of areas of discussion today. I think first is really understanding what pension rules are. I'll be sharing some information on that. Then I'll go through seven planning sort of points for different range of people, from those who've got families to those who've got businesses, how best they can utilize pension to really one safer retirement, but also make sure that they kind of save in a tax efficient way. Sharia compliance is very important to our clients, and again, this is something that I'll touch upon and kind of share some insight into that. And then obviously we had the budget yesterday, so I'll give you a quick sort of one slide or one snapshot on key sort of budget updates, which I guess are relevant to the topic which we are discussing today. So pensions. So broadly speaking, there are three types of pensions, or pensions can be categorized in sort of three different ways. So the first is the state pension, which, as the name suggests, is simply a pension which is offered by the government or the state. The second is the workplace pensions, which are offered by your employer, and they are further categorized into sort of two categories. One is defined benefit, which essentially quite a lot of range of different types of defined contribution schemes, but in principle, defined contribute the performance of the investments. And third, there are private sort of pensions, which are also a third category which essentially is, rather than having a pension with your workplace or your employer, you set one up with a third party, entity, the like of, Simply Ethical or the likes of AJPL or Hargreaves Lansdown. So state pensions, to be eligible for state pensions, you must have at least 10 years of qualifying, 10 years worth of qualifying years. Either you're working or, in simple terms, in the system. So 10 years is the minimum to achieve the full state pension, of which currently amounts to roughly £220 a week. For a year, it's £11,500 a year. One needs to contribute for at least 35 years worth of NI contributions, national insurance contributions, to benefit from the state pension. In terms of state pension age, it depends on your date of birth, but generally speaking, as it stands today, the state pension age is 66 for female and for male as well. And then eventually, I think over time, it's going up from 66 years of age to 68. But again, it depends on what your date of birth is. One of the sort of positive things about state pensions is that it does go up in value in line with the higher of the consumer inflation, 2.5%, or the rise in wages. So whichever sort of points is the highest in terms of rises, be it prices, wages, or 2.5%, it rises in line with that. So I think it is inflation protected in that regards. Sorry. So this is a quick comparison of defined benefit schemes and defined contribution schemes. Essentially, there's sort of four different ways of looking at it. Um, uh, First is how are the pension benefits determined for both these schemes? When it comes to defined benefit schemes, also known as final salary schemes, the pension benefits depend on one, your final salary, or it could be your average salary during the time you work with your employer. And secondly, it depends on the number of years you've spent with a given employer. So defined benefit schemes essentially depend on length of time you spend with the employer, and also the final salary or the average salary. And every sort of provider would work out, I guess, the benefits or slightly differently. But in principle, that's what I've explained. It gives you an idea. In terms of defined contribution schemes, which currently most people will have through their workplaces, and also private pensions, which we offer and other entities offer in the market, also are based on this defined contribution method, where essentially the pension contributions depend on pension benefits depend on one, the contributions that you make. Secondly, it's the employer contributions. And third is how investments perform. And that kind of dictates what retirement pot you will end up when you do retire. So they kind of move in line with the performance of the investments. In terms of the investment side, when it comes to defined benefit schemes, there are again sort of subsections. There are some schemes which are funded schemes where they would potentially be invested in investments, and a good example of that is a local government pension scheme. And there are unfunded schemes which are backed by the UK government, the likes of NHS schemes. So where almost kind of safe to say that the investments are kind of non-existent in those type of pension schemes. When it comes to defined contribution schemes, the invest the employee is responsible for the investment. So what generally tends to happen is when you get auto-enrolled into a pension scheme through your workplace, there would be a default option, and more likely it would be a non-compliant option. But the workplace pensions would give you an option to pick any option, including a sharia option. So you do have that sort of control of choosing whatever investments options you wish to choose. In terms of the income from retirement for defined benefit schemes, there is a guaranteed element to it. Whereas for defined contributions schemes, it's really dependent upon the performance of the investments and the contributions that you make. One of the sort of main benefits of the defined benefit pension schemes is that it does benefit from inflation protection. So the benefits do rise in line with inflation, which is a huge positive. Whereas with defined contribution schemes, inflation protection is not really built in, but the whole concept is kind of reliant on the investments performing much better than inflation to produce a decent retirement pot for individuals to retire on. So what are personal pensions? So personal pension, just like workplace pensions, are simply a tax efficient way of saving for retirement. So sort of broadly speaking, there's sort of three tax benefits to this. One is the tax relief on the pension contributions that you make. So in simplicity, whatever tax rate that you pay, that tax rate, rather than rather than that amount going to the tax money, ends up going into your pension pot. Second, once your contributions are in a pension pot, it grows tax free. So there is no capital gains tax, there is no income tax while the money is being invested in a pension pot. And the third is when you do retire, which the current sort of private pension, current sort of minimum pension age is 55 for defined contribution schemes, which include personal pensions, which would be rising up to 57 in April 2028. At that sort of point, you're able to take out 25% of the money as tax-free lump sum, and the remaining remains invested, and one can just take out money as and when they need. So often, there's a large number of people who have an understanding or have an assumption that you have to wait till 65 or 66 or 67 to access your workplace pensions or private pension, but that's not the case. So currently the age is 55, but it's moving up to 57. So there is scope for individuals to actually retire before the state pension does arrive. So I've just given an example of Daniel, who's 39 years of age, and his retirement sort of age, which he's looking at, is 57, so it's 18 years from now. So that's sort of the planning period where he will decide how much to invest and what sort of income he needs to target when he does retire, which is at the age of 57. So that's the sort of planning sort of time period. Once he reaches 57, it would give him access to his personal pension and workplace pension. So this is sort of the blue sort of box in the middle, PP representing personal pension and WPP standing for workplace pension. So essentially, once someone reaches 57 years of age, they can access their private pensions or workplace pensions, and one can start benefiting from retirement. And in this example, the state pension, which amounts to roughly £220 a week. So how do pension tax reliefs work? And essentially, based on the tax rate you pay, that would determine how much tax relief you get. So let's just take an example. For a basic rate taxpayer, they would put in £80 into a pension, and they would get £20 worth of tax relief. So every £100 that you put into a pension, you would get 20 worth of relief for 20% tax relief. For a high rate taxpayer, 100 tax reliefs. Now, one of the sort of key things to sort of point out is when you do make a contribution to into a private pension, what happens is that you would make a contribution normally after you've paid the taxes. So let's take an example of high rate taxpayer. You would pay £80, and the pension provider would claim the 20% tax relief, and that would take up your that particular contribution up to £100, and then the remaining tax relief, 20% in the case of high rate, you would claim that from the by doing tax returns. And likewise, if you are additional rate taxpayer, then you would be looking to claim £25 for every sort of £100 worth of contribution. So essentially, in simplicity, whatever you pay in tax, rather than that going to the taxman, essentially ends up being in your pot. So what are the annual allowances? So annual allowance kind of is a term that's used to state the maximum contributions that one can make into a pension and get a tax relief on. So if he's going to start from the left-hand side, so anyone who's not earning anything at all, or earning less than £3,600, they are still able to make a pension contribution and get a tax relief. So for a person who's not earning anything, they can contribute £2,880 into a pension and get a 20% tax relief amounting to £720. So even non-earners can get a tax relief. The standard allowance, which is the sort of the green sort of circle, the second circle, is £60,000 or 100% of the earnings, whichever is lower. So let me just give you an example. So if someone is earning £30,000 a year, the maximum contributions that they can make into a pension and get a tax relief is limited to £30,000. But if someone is earning £80,000 a year, the maximum allowance they can use to get a tax relief for that particular tax year is limited to £60,000. The 60,000 is the maximum sort of allowance, and there are sort of other sort of two allowances which are relevant for certain people. One is called tapered annual allowance, which reduces the annual allowance from £60,000 to £10,000, which is relevant for individuals who got adjusted income about £260,000. And there is something called money purchase annual allowance, which kind of limits the annual allowance to £10,000. And that really kicks in when you start to take income from defined contribution schemes. So pensions, allow. There's a number of rules around pensions, and I think I'll just quickly highlight what's in this slide. So one of the benefits of pensions is that you can carry forward your allowances. So any allowance which you haven't used in your previous 3 tax years, you can carry them forward. And I'll kind of demonstrate this, in an example shortly. So there is a way of carrying forward your allowances if you have not used them. Retirement age when it comes to private pensions or defined contribution schemes, as discussed earlier, they are currently 55, but rising up to 57 in April 2028. Now, there is something called a lump sum allowance, and that kind of refers to the maximum tax-free lump sum that you can take, and that's really limited to 268,275. So that's the maximum sort of lump sum that one can take from a pension. And there is something called lump sum and death benefit allowance, which is just over £1 million, which really becomes relevant, especially when you're looking to, when someone does depart away, and then it's the case of distributing those benefits. Then there is, this amount would dictate how the pension gets taxed. So in terms of taking out money from your pensions, broadly speaking, there are sort of 3 options that one has. So one is a flexible income or drawdown option. The other is what's called the individual lump sum option, and then the third is annuity. So in terms of annuity, in simplicity, annuity is let's kind of take an example where someone has got a pot of £100,000. They take 25% of that as tax-free lump sum, and they have the remaining £75,000 left. Now, they've got 2 options. One option is they could give that, buy an annuity, which is essentially giving that money to an insurance company, and they would guarantee an income for life. The other option for them is to go down to a flexible drawdown, where that £75,000 would remain invested, and as and when the member needs to dip into or take money out from their pension pot, they can do so. Annuities, because of the guaranteed element and the insurance side of things, is not permissible from a sharia perspective. So that's not an option for, I guess, the Muslim pensioners to consider. But the other 2 options, drawdown and individual lump sum, both of those options are sharia compliant. So what happens to your pensions when you depart? Now, it really depends on your age. So so if you pass away before the age of 75, and the beneficiaries that you've selected for your pension take an income from your pension that you've left, then there would be no tax on it. And that the same applies for also the lump sum as well. The only exception is where if the lump sum is above the £1 million, £1,073,100, then there would be a tax which would be applied on it, and that tax is applied based on the beneficiary's marginal sort of tax rate. Now, in the case of if a member or a person who's got a pension dies from 75 years of age onwards, regardless of why the beneficiaries take an income from their pension or take a lump sum, they the pension pot would be taxed on their marginal rate. I think the key thing to point out is that these tax benefits or options which are shown here are relevant if the benefits are taken within 2 years. In the event that you do not take the benefits within the 2 years, then the tax would apply on regardless of the age, on any type of pot, whether you take it as a lump sum or you take it as income, and that also applies even if your age is below 75. So one sort of quick note is, most people nowadays have a pension scheme either through workplace pension or they have a private pension scheme as well. And one of the things which I would sort of guide and advise everyone who's got a pension is to make sure that they fill out what's called an expression of wishes form, which essentially nominates individuals and the proportions in terms of where your money should go when you depart, when you pass away. So that again is something that I would encourage everyone to complete. It's important to sort of point out is that pension savings are usually not covered in a will, because they generally are set up as a trust, which gives them that sort of advantage on the tax side, i.e. the inheritance tax side of things. And hence, I think it's important to make sure the expression of wishes form is completed, which for most pension providers, that can be done by logging into your online user and updating the beneficiaries and the proportions. So one thing I would sort of mention here is that when it comes to if the expression of wishes form is not completed, then it's kind of left up to the trustees of the pension scheme to decide how best to distribute one's pension. Now, one may share their will at that time, and then the key thing here is that the discretion rests with the trustee of the pension providers. But generally speaking, if one has completed the expression of wishes form, then one would expect that the pension provider would follow through with that. Again, you can build out your proportions based on Islamic inheritance law by looking at your own sort of family dynamics and kind of evolve this over time based on changes in the family. So this is a quick snapshot on the pension side of things. I'll go through sort of 7 planning opportunities. So just before that, there's sort of 4 stages to building a sound retirement plan. I think first step really comes with understanding what exactly are pensions, how do allowances work, where are the sort of planning opportunities. Then the second step is more about trying to understand how much do you need to save to get to your target sort of retirement pot, and what are the right options, pension options for you. Is workplace pension the better option for you? Is it a private pension, or is it a different type of pension scheme, or is it a combination that works for you? And step 3 is choosing the right investment strategy, which will help your pension pot to grow and deliver on your income objectives in retirement. And fourth is really looking at how best you will extract money from your pension, because there are a number of options which I briefly discussed, from flexible drawdown to lump sum income, and there are other options as well. So just before we go through the planning opportunities or options, which it's worth going through the income tax allowances. So the first £12,570 that anyone earns, there is no income tax on it. For basic rate taxpayers, from 12,571 to just over £50,000, the tax rate is 28%. And then from just over £50,000 to roughly around 125k, the tax rate is 40%. And then over 125k, the tax rate goes up to 45%. I think the key thing which is worth mentioning is as you earn above 100k, earn above 100k, for every £2 that you earn, your personal allowance reduces by £1. So essentially, by 125,000, 140, one would have lost fully lost their personal allowance. So I'm going to go through sort of three options or planning options uh, for individuals who've got families, perhaps married with kids, something which may be relevant. So I'll go through those three planning options. So the first one is something to do with marriage allowance. So 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 there is something called marriage allowance, which is essentially open to individuals, one, who are married or in civil partnership, and secondly, both partners are not a high rate taxpayer, i.e., they're basic rate taxpayer, and in the case of one spouse, to really make it work, you would expect one spouse to be a non-taxpayer and the other spouse to be a basic rate taxpayer to make it work. So essentially, one, in the case of if you've got a person, one spouse is not earning, they can transfer their personal allowance worth 1,260 to the spouse which is earning money, and that will help reduce the annual tax by £252 basically. So that's on the marriage allowance. Now, why is it relevant when it comes to pension planning? And I'll just kind of go through an example. So here I've got an example of a person who, Mr. A, he earns £55,000. He's currently contributing £3,730 into workplace pension, and his wife doesn't earn any income, so she's not really utilizing the personal allowance. Now, given that this individual, as it stands now, before making a pension contribution, he is not able to utilize the personal allowance for his wife because he's a high rate taxpayer. Now, the way he can potentially use or have the marriage allowance transferred to him is, in this case, is to simply make £1,000 of additional pension contributions. That could be a workplace contribution or through a private pension scheme, and that would bring his taxable income down to a level of a basic rate taxpayer, which essentially means that on that sort of marginal £1,000, he would get the 40% tax relief. But also, by going from a high rate taxpayer to a basic rate taxpayer, he would be able to benefit from the marriage allowance and gain additional £252 a year, which essentially means that for that sort of the marginal benefit for £1,000 contribution is actually more than 40%. It is actually 65.2%. So this is quite relevant for individuals who are very close to this sort of or just about hitting that sort of higher rate tax band, and they are married. So it's something for them to sort of consider potentially raising their pension contributions to really benefit from the marriage allowance. The second option or second planning point, which is relevant for individuals who and for generally speaking, anyone who's married and have kids, they're able to get child benefits for two children. I think for the first child it's £25 and 60 pence per week, and then for the second child it's £16 95. And collectively, in terms of annual sort of say, annually that amounts to £2,212 and 60 pence. So that's an amount one can benefit from, assuming their salary is below £60,000. Now, if there is, I guess, we take an example here of a person, Mr. A and Mr. and Mrs. A. They've got two children, and they're getting child benefits for both. And Mr. A earns £59,000, and you know, uh, you know, he ends up getting a 21,000 pounds bonus, which is a quite his income down to £80,000. Now, as he hits that £80,000 mark, he will fully lose his tax child benefits, because the way child benefits sort of work is that for every £200 that you earn above 60K, your child benefits would reduce by 1%. And by the time you get to an income worth income of £80,000, you would have lost all your child benefits. Now, the way to kind of save your child benefits, in this example, is what I've kind of shown here is that Mr. A can simply pay £20,000 into a pension. He would get the 40% tax relief, but also by actually making the pension contribution, he would reduce his adjusted net income to £60,000, which means he can retain his child benefits just above £2,000. So that marginal benefit of him making £60,000 is actually more than 40%. It amounts to roughly 51%. So that's another sort of planning point for married couple, where one couple is working and other is not. A very nice and simple option is that for a non-earning spouse, one can still set up a pension for them, a personal pension for them, and they can still benefit from tax reliefs. And the tax relief, they can get essentially one can contribute in gross £3,600 into a pension. So how that works in practice, you would set up a personal pension plan, and then you would contribute 2,880 into your the spouse is not earning into their pension, and the taxman or HMRC would top it up by another 20%, which amounts to £720. So essentially, even if someone is not working, they can still contribute to pension and get a tax relief, which amounts to £720 a year. And that, again, if you kind of do that over 10, 20 years, it all adds up, especially when you've got the money invested and grows over time. So now I've got sort of four sort of planning points for individuals who've got who've got high earnings, 100K plus, individuals who've got businesses, i.e. limited company. What are the pension options for those individuals? So, so I think the first one planning point, which is relevant for those earning between 100K to 125K. Now, as I explained before, as your income goes above 100K, then what happens is that for every sort of £2 that you earn above 100K, your personal allowance reduces by 1%, and which means your effective tax rate for that marginal amount between 100K to 125K ends up being 60%. So one of the options for individuals earning above 100K or between that 100K to 125K bracket is to really consider raising their pension contributions. So So let's just kind of take an example. So someone who's earning 100K receives a very small 1,000 pound pay rise. Now, which will be taxed at 400 pounds, which will be taxed at 40%, which means they will lose 400 pounds worth of income tax. Now, given that the income has gone up to 101,000 pounds, they would lose 500 pounds worth of allowance. And on that sort of 500 pounds extra, they will end up paying 40% tax. So which means on that sort of marginal 1,000 pounds amount, you are paying 400 pounds worth of income tax, and then you're paying additional 200 pounds because you're losing your personal allowance. So essentially, your effective tax rate is 60%. So if a person in this sort of salary bracket, if they were to simply make 100K, 1,000 pound worth of contribution, then they would get an effective marginal tax relief of 60% on this amount. Other thing for individuals who've got large amounts, large income above 100K, it's very likely that inheritance tax would be an issue. And I think one of the ways of actually distributing wealth to children is perhaps looking at junior pensions. So one can set up pensions for their children. So and again, there is a limit in terms of how much one can contribute towards it, and that's kind of limited to £3,600, including the tax relief. Now, in terms of when you transfer or put money into a junior pension, then that essentially can be, from an inheritance tax perspective, can be accounted for within either the annual gift exemption of £3,000, or it can be treated as gift out of income, which means it will be inheritance tax free, basically. And and the way junior pensions work is that the guardians or the parents will have control over the child's pension before the age of 18, and then after that, the child would essentially take over their own pension and had a full ownership of that control as well. Yeah. So this is an example which is really relevant to a lot of the self-employed sort of business owners with limited companies. Now, tax reliefs on contributions paid by, I think it's worth mentioning that when an employer makes a tax contribution, makes a contribution, pension contribution into a pension, there are no limits to it. So I guess an easy way to explain this is, if someone is earning £30,000 through their limited company as a salary, now the maximum contribution they can make in their individual capacity is limited to £30,000 in terms of getting the tax relief. But through their employer, they're still able to make the additional £30,000 worth of pension contribution to really max out the annual allowance of £60,000. So when it comes to employer pension contributions, there is no limit. But I think the key thing which is worth mentioning is that the pension contributions which are made by employers have to fulfill that rule around being wholly and exclusively for the purpose of the business. So here I've given an example of in the table of someone who's got a limited company, and they would not have used their annual allowances for the past 3 tax years. So in 2021-22, they had an annual allowance of £40,000. They did not use it. Likewise, in the next year, they did not use it either. And it may well be the case that the business is growing and the income is low in terms of the revenue for the firm. And then over time, as the business grows, the business has more capacity to make those pension contributions. So come year three in 2023-24 tax year, this person makes a £20,000 worth of contribution. So it's used essentially using 20,000 off the 60k worth of the pension contributions. And then come this year, they have the full 60k allowance, but they are also able to carry forward the previous 3 years worth of allowances which they haven't used. Which, when you add up for the previous 3 tax years, it's £100,000 for the previous 3 years, including the 60k. So in total, potentially this person can make pension contributions worth 160k through based on through their limited company, or from their employer. So there are opportunities there for individuals who've kind of missed out on pension contributions in previous years, because you can carry forward allowances. Now, one of the good things that you can do with pensions and is simply to buy commercial property, and that might be commercial properties like offices or your shop building, or it could be a dental practice, and it generally suits individuals who've got a large investment pot. They would need a certain type of pension. SIPs or SAS are the two pensions which may work in terms of potentially buying a commercial property. So contributions, worth 350k into a pension. It could be on behalf of one director or a number of directors, or a number of years, and they build up sort of the pension pot worth £350,000. Now they can use that money to buy a commercial property, which is here we've got the sort of property seller. Now that seller potentially can be the individuals themselves, where the commercial property which one is using for their business is held individually. Now they can potentially sell that to the pension, and one liquidate their sort of money and have the cash, but also allow for the pension to own that sort of commercial property. Now what that sort of does for an individual who's holding a commercial property is, one, when the pension contributions are made, the company gets the corporation tax relief. So they benefit from tax relief, which could range from 19% to 25%, based on the amount of profits being generated by the company. There is obviously a corporation tax relief on rent, and that's assuming if the commercial property is rented out back to the company for them to use for the purpose of the business. Now the business can pay the market rent to the pension, and the pension benefits from the income, and the company paying the rent would deduct the rent naturally as an expense, and hence they get the corporation tax relief. And I think the other sort of point around this is obviously, once the commercial property is in a pension, it benefits from, one, there is no income, tax on the income being generated in the pension, and secondly, there is no capital gains tax as well. So again, pensions can be used by small businesses or medium-sized businesses, and there's a lot of ways around planning for that. And again, the underlying investments don't have to be stock market related. You can buy commercial properties as well, and there are a lot of other assets potentially one can buy as well. So these were sort of seven sort of planning points. We'll quickly just go into the Sharia compliance of pensions. So when it comes to making sure pensions are Sharia compliant, so here I'm kind of referring to pensions like personal pensions or your workplace pensions, which are based on defined contribution schemes. you can break down the Sharia compliance into essentially three bits. So one is making sure the investments which you invest in are Sharia compliant. So you invest in Sharia compliant ETFs or funds, and then also the investments, if they're held in private pensions, is to make sure that they're traded in line with the Sharia principles, because there are some rules around how investments should be traded, and they need to be followed. Then, in the case of individuals who are holding personal pensions, generally they would tend to have a small amount or perhaps a large amount of cash in their pension, while the rest of the money may be invested in funds and ETFs. Now, one of the questions to think about is, what happens to that cash? Is the cash receiving interest or not? Now, if it is receiving interest, that's not ideal. Ideally, it should be a non-interest-bearing bank account, if not a Sharia-compliant bank account. In the event that it's not possible to um, uh, 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 um, not receive interest, then one can potentially cleanse that money, which is not ideal, but again, is something that one can do. The second thing is, once your pension is invested, is making sure one, the zakat is calculated and also distributed or paid out, and that's something. So when it comes to Simply Ethical, we work out the zakat for our clients, and we will let you know based on the portfolio that you hold with us. Your zakat rate for this portfolio is X percentage, and you would simply apply that to your account and pay that to a charity of your choice. There is also income purification calculations which need to be done, because there is a certain non-purified income that needs to be purified for certain investments. Again, that's something which we calculate, and where relevant, we would share that with our clients as well, basically. Yeah. In terms of taking pensions, uh, uh, like mentioned previously, annuities are not permitted. So for clients who are looking to withdraw pensions, they should be considering flexible drawdown option as one of the amongst other options. Second thing is making sure that your expression of wishes form for any given pension is completed in line with the Islamic inheritance law, to make sure that in the event that you depart or pass away, that your pension is distributed in line with Islamic law. So this is a quick snapshot of conventional pensions versus defined Sharia pensions. And essentially, it's simply the case that investments have to be Sharia compliant. Cash in the pension account has to be non-interest. There should be no interest on it. Ideally, it should be in a Sharia compliant bank account. In terms of taking money out from pensions, annuity is not permitted, so other options like flexible drawdown should be considered. And when it comes to death benefits, it's the case of making sure you complete the expression of wishes form in line with the Islamic inheritance law. It's worth sort of mentioning the zakat treatment on pensions. So when it comes to defined benefit schemes, there is no zakat on pensions. And the reason for there being no zakat on defined benefit schemes is because defined benefit schemes are treated simply as a form, or the pension is treated as a form of remuneration. So for the time that you spend with the employer and you work, and you get remuneration, one, through salary. There might be some benefits around perhaps medical benefits, but along with that, pension is also considered one one of the benefits and part of the remuneration. And as a result, it is not treated. As a result, zakat is not applicable on defined benefit schemes. The most important thing, which is sort of worth mentioning, is that um, when it comes to defined contribution schemes, where personal pensions and defined contribution schemes, workplace pension schemes also come into it, zakat is applicable. And the reason why it's applicable is that one, the member has ownership and control of the investments, which is not the case with defined benefit schemes, because with defined benefit schemes, it's a simple remuneration, the way it's structured, and the client or the member, pension member, doesn't have a say on where the money should get invested. So again, the zakat treatment for both pensions is different. Uh, and then just a last slide on the zakat side of things, which is really relevant to all the investments. Um, but the reason for including this here is that one of the things which I kind of discussed was the junior pension, which is pension for the kids. Now there is a difference of opinion on why the zakat is applicable on assets held by children or not. So when it comes to Hanafi school of thought, they are of the view that zakat does not apply on children. Whereas when you look at other schools of thoughts, they have a different view, which is essentially that zakat should be payable regardless of whether someone is adult or a child. So again, something to bear in mind when you're working out the zakat for junior pensions. Okay, and just quick one slide sort of update on the budget. So we had a budget announcement yesterday, and I just highlighted sort of three points which are relevant. So stamp duty for a second home has gone up. It's gone up, increased to 5%. Inheritance tax, I mean, that was quite a big change. Generally, pensions are seen as inheritance tax free, i.e., they are generally treated as being outside of the estate for inheritance tax purposes. But that's due to change from 6th April 2027, where essentially pension assets will come under one's estate for the purpose of calculating inheritance tax, basically. So again, something to bear in mind. Capital gains tax, again, is one of the key changes in the budget. Now, capital gains tax for both basic rate taxpayers and high rate taxpayers have gone up from 10% to 18%, and then 20% to 25 to 24%. So it's pretty much in line with the second properties now, which means the need for ISAs and which allow for tax-free growth, and pensions similarly. There is a need and for such options, and one should consider those options. And I think that's it, and that's the end of the presentation. And happy to take any questions. Yeah, I think we have no more questions, so we can close the session here. So apologies for the delay today. Hopefully you found this session useful. There's a lot of detail in there, a lot of things which are complex in nature. So I would suggest everyone to have a look at our blog website, and there's some good stuff in there. There's hopefully there will be a commentary on or highlights of the budget announcement, which will be there, along with other useful articles. You can also have a look at our FAQ section, which does address key questions. And feel free to book a consultation either with myself or any of our advisors. And you can do that by going onto our website. So any queries, drop us an email at info@simplyethical.com. And we'll happily help you, inshallah. So thank you for joining. Have a good day, and bye for now.